The top business stories live from the Sky News City studio. British gas profits rise by nearly 900%, but its parent insists it's a one-off. The US Federal Reserve raises interest rates to their highest level in 22 years as it continues to fight inflation. And shares of Barclays fall by more than 6% after the bank warns its net interest margin will be lower than expected this year. Good morning, this is Business Live with me, Ian King. It is a huge day today for company results right across Europe, and over the next half hour we'll be bringing you some of those numbers which provide a snapshot of how many parts of both the UK and global economy are faring. Well, we begin the programme today with results from the energy sector, with the parent company British Gas again the target of politicians and poverty campaigners, following a strong rebound in profits. Well, Centrica reported a near tenfold rise in half-year earnings at British Gas, but stressed it was only likely to be a one-off. The company, which also owns a 20% stake in the UK's remaining nuclear power plants and the UK's biggest gas storage facility, reported an operating profit of £2.1 billion for the first 6 months of the year. That was up from £1.34 billion in the same period last year. Well, a major contributor to that was British Gas Energy, whose operating profits rose from £98 million to £969 million. The company said this was due to the energy regulator Ofgem, allowing it to recoup previously lost costs through the energy price cap. It also announced a further £50 million donation to help support customers struggling with their energy bills. Well, in a statement today, the energy regulator Ofcom said in response to the British Gas profits this: the profits we'll see in the energy retail sector for the first half of this year are a one-off, as suppliers recoup some of the genuine and significant costs and losses they incurred over recent years due to the COVID and the Russian invasion of Ukraine. We expect profit levels to fall back significantly, moving forward to the reasonable and modest levels allowed for in the price cap. Reasonable profits are important for the sector to be sustainable and provide good customer service, healthy competition and innovation. Well, meanwhile, Shell has reported a sharp drop in quarterly profits. The oil and gas giant said a fall in energy prices since the start of the Russia-Ukraine war were to blame. Well, Shell, the company, the world's biggest producer of liquefied natural gas, reported adjusted earnings of $5.1 billion for the 3 months to the end of June. That was down from $11.5 billion in the same period a year ago. The numbers, which fell short of market expectations, were the lowest quarterly earnings from Shell in nearly 2 years. Shares of the company have fallen by just over 1% this morning. Now, the US Federal Reserve returned to raising interest rates last night, having taken a pause last month, taking them to their highest level in 22 years. The Fed raised its main policy rate, Fed funds, to a range of between 5.25% and 5.5%. That was up from the previous range of between 5 and 5.25%. It marks the Fed's 11th interest rate rise since it began hiking in March 2022. Well, joining me now is Andrew Bell. He's Chief Investment of Witten Investment Trust. Andrew, good to see you this morning. I mean, this was largely priced in, it has to be said. I mean, the big news, I guess, was that the Fed has left the door open to further rate hikes later in the year.
I think there were two bits of big news. One was that they seem to have dialed back on their concern that the US might hit a recession later in the year. They're now sort of suggesting that growth will slow down, but it's been more buoyant than expected so far, so they're not predicting a recession. The other thing was that in the press conference afterwards, Jay Powell seemed to emphasize that he chose not to reinforce the idea from the last meeting that they might have 2 rate hikes to go. So he said it's going to be completely data dependent. We might raise, we might pause. Despite the fact the growth outlook had improved, he seemed keen to avoid reinforcing the idea that they might move rates higher. So I think that was a bit more dovish than people thought.
Do you agree with their assessment that the US is likely to dodge a recession this year?
Yeah, on balance, I do. Clearly, there are a lot of things, perhaps more in the UK economy than the US, but a lot of things that suggest that the lags between rates going up and the economy slowing down might be a little bit longer. So probably some of the pain is yet to be seen. But the reaction of the US economy, the buoyancy of the consumer, the pickup in investment in infrastructure, which is obviously driven by government programs, and the fallback in inflation suggests that the economy is behaving better under this stress than expected. So even though we're at 20-year highs in terms of interest rates, that's because we've just seen a 30 or 40-year high in inflation. So I think the Fed is, I mean, if I had to guess, I think they probably are done now, but I don't think rates are going to come down anytime soon. I think they're going to look for a plateau and keep bearing down on inflation. And if that means it takes 2 or 3 years to get inflation back to 2%, that's probably better for the economy than crash landing it and then having to cut rates like hell to like Billy-O to get it revived again.
Now, in a couple of hours' time, we obviously get the latest interest rate decision from the European Central Bank. Again, most people are expecting another rate rise. Do you go along with that?
Yes, I think so. And it's more likely that they'll put rates up again in September for a couple of reasons. One is that the ECB started raising rates from a much lower level later than the US, so they're further behind in the track. The other is that the ECB culturally has a history of spelling monetary rectitude with a capital W. So even though the economy appears to be weaker than that in the US, I think they're probably going to err on the side of making sure that they get rates as close as they can to 4% before they halt.
They have a real challenge, though, the ECB, don't they? Because rates are not, inflation's not coming down as rapidly in the Eurozone as it is in the US, as you say. But yet in some countries, notably Spain, it is. It is.
Well, I suppose that's the problem, that you have a monetary policy which is set for a wide range of countries. And for much of the last 20 years, the policy was too loose for Germany and too tight for Southern Europe because their economies performed less strongly. I guess there's a little bit of that going on at the moment. But I think in the end, the signs in the last few years has been that when push comes to shove, the ECB will act in a way that compromises Germany's interests in favour of the greater good. So I don't think they will go really gung-ho and push rates up and up till German inflation starts coming down. And actually, let's face it, the German economy suffered quite a bit from both the energy shock, where they were over-dependent on Russian energy sources, and also from the weakness of demand in China. So one, maybe two more raises from the ECB, and I think that'll be it. But the economy does look a bit more flaccid than that in the US.
Indeed. Andrew, got to leave it there. Appreciate you joining me today. Thank you.
Pleasure.
Oh, a flood alleviation scheme in Newhaven, the modernisation of roads and pavements in Birmingham and building a new railway station in Cambridge may not appear to have that much in common, but all are projects on which Arcadis, the design, engineering and consultancy services provider, has been working. Today, the company, which is listed in Amsterdam and has a stock market valuation of €3.5 billion, reported an operating profit of €93 million for the 3 months to the end of June, which was up 36% on the same period last year. But joining me now is Alan Brooks. He's the Chief Executive of Arcadis. Alan, good to see you today. You are seeing growth in all business areas. Which are the standouts for you?
Yeah, I think there's some really good growth areas that we're seeing now. Obviously, energy transition, particularly when you look across Europe, you're seeing the demand for movement to renewable energy. So that's a big growth area for us. But also carbon reduction. And I think we're seeing the start of demand for sort of EV charging and things like that since we see it in the southwest. So some really good opportunities for us. And it's just choosing now where are those growth markets for businesses.
Obviously, Joe Biden is incentivising businesses that invest in the energy transaction pretty generously. Does that make the US a more attractive location for you?
The US is attractive, certainly because you've got the stimulus packages, but you're also seeing this across Europe as well. So I think where you're seeing governments get behind big schemes, so that could be energy, it could be infrastructure, they're obviously using these mechanisms as well to try and keep the countries buoyant.
How do your revenues break down between public sector and private sector work?
Yeah, it varies slightly year to year, but rough and tough, we're about 50-50, to be honest with you, Ian, and that's to give a good balance around, keeping the business resilient as well.
Now, a lot of what you do is linked to mobility, as you've already hinted there. And I was quite caught by the line in the statement. You say highways and rail clients increasingly look for data-driven solutions. What does that mean in practice?
Well, it could mean a number of different things. One could be if you take a railway line, how do you keep a railway line working? So you can use data, interestingly, you can use sensors. Railway lines start to fail around junctions if temperatures rise on the tracks, so you then look to maintain them. But also, increasingly, cities are looking at their parking. Curb IQ that we have as a product is something that tracks where parking and logistics are available for deliveries. So people are using data far more now in mobility areas to really get more efficient, I guess, is the way to look at it.
Now, the UK government recently mothballed work on HS2 at Euston Station due to cost concerns. You think that's a mistake? Why?
I do, because if I'm coming into London, I live south of Manchester, and if I'm coming into London, I don't want to go to Old Oak Common. I want to come into Euston, so that's one thing. Secondly, I think it's a missed opportunity for regenerating the Euston area, and I think we could really see the government getting behind these regeneration schemes. And again, it should be going through to Manchester as well, because then you're also part of the levelling up scheme that I think the UK government should be looking at.
Alan, great to talk to you this morning. We have to leave it there, I'm afraid. Thanks for joining me today.
OK, no problem. Thanks, Ian.
Now, shares of Barclays have fallen by more than 6% today after it warned that its net interest margin, that's the difference between what it charges borrowers and pays depositors, will be lower than expected this year. Well, the lender was reporting a pre-tax profit of £4.6 billion for the first 6 months of the year. That was up 22% on the same period last year, although when litigation and conduct charges a year ago were stripped out, profits were actually lower. Well, the bank's chief executive, CS Venkat, has been speaking with our sister channel, CNBC.
We've been seeing increasingly people who are responding to higher inflation, higher interest rates on their mortgages, use their savings to pay down their mortgages. I think this speaks to two things. One, it speaks on the part of our customers to their own prudent financial management. That's what they should do, right? When they're paying higher interest rates, if they feel comfortable using their savings, they should use them to pay it down. Second, it speaks to the quality of our customers. We have generally been very conservative in our lending guidelines, and we have a set of customers on margin who are able to do this.
Well, Wall Street's solid finish last night, during which the Dow Jones Industrial Average completed a 13th daily gain for the first time since January 1987, was followed by a largely positive session in the Asia-Pacific region. Highlights overnight included Sydney, where the main index hit its highest level for 5 months. But in Europe, stocks are also trading to the upside ahead of the ECB decision this lunchtime. There are stacks of company results to digest. Highlights include Nestlé, which is ahead by some 2% in Zurich. To the downside, Volkswagen is off nearly 4% in Frankfurt after warning it will deliver fewer new cars this year than expected. Well, here in London, the FTSE 100 is also in positive territory, albeit only 12 points to the good or so. Centrica, which I mentioned earlier, is the leading gainer. A clutch of other blue chips are also trading higher on their results this morning. They're led by the exhibitions and information supplier Informa. The shares up nearly 4.5% there. Rentokil Initial, another household name there, up some 2%. Fraser's Group, that's Mike Ashley's company, of course, they're trading higher on their results. And also Relx, who we'll be hearing from later in the programme. To the downside, St James's Place, the wealth manager, is off by some 15% after reporting a drop in profits. Outside the FTSE, again, it's a really busy day for results. Jupiter Asset Management, probably the pick of the bunch, up 13.5% there, and we'll be speaking with the chief executive of that company in our afternoon edition. On the foreign exchange markets, well, the euro is stronger going into the ECB rate decision. Sterling ahead by nearly 1/5 of 1% against the dollar, but off by nearly 1/4 of 1% against the euro. The single currency up nearly 1/2 of 1% right now against the US dollar. As for the oil price, well, that remains close to its 3-month high. The focus is still very much on tightness of supply. A barrel of Brent crude will currently set you back $83.39 a barrel. That's up a little over 1/2 of 1%. Well, joining me now is Rachel Winter. She's partner at Killick & Co. Rachel, a huge day for company results. Let's start with Barclays. Obviously, the share price has taken a bit of a hit today. Oh, dear, we do appear to have lost Rachel Winter, unfortunately. We'll try and get back to, as I say, there's an absolute blizzard of company results today. 16 alone in the FTSE 100. I'll be trying to plough through some of those in my piece for our digital platforms later on. Well, we're going to go to a break now. Still to come, though. I've been speaking, as promised, to the Chief Financial Officer of Relx. It's the 11th largest company in the FTSE 100. To hear what he's got to say, stay with us.
They pushed the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'm gonna have nowhere to live for about 3 or 4 months.
There are still people inside the properties here.
They're coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight.
What's your feeling about the future then?
Blake might all be finished, I don't know.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, it's often suggested these days that data is the new gold. One company unlikely to disagree with that assessment is Relx, which supplies analytics and decision tools for professional and business customers in the risk, scientific, technical and medical and legal sectors. The 11th largest company in the FTSE 100 this morning reported a pre-tax profit of £1.35 billion for the first 6 months of the year, up 16% on the same period a year ago. I've been speaking with the company's Chief Financial Officer, Nick Love. I began by asking him whether this was just the ongoing recovery from the pandemic in its exhibitions arm.
Well, there's obviously some recovery there, but I think the key thing for the overall numbers for the group actually is the step up in electronic growth to 7% from 6%. There's a bit of recovery, as you say, in exhibitions and a bit of a drag for print, which gets you to a net 8% overall. But actually, the core driver is the electronic growth, which is nearly 85% of the group's revenue. And that's where we're getting the analytics going in legal, in SDM and in risk.
Obviously, Relx has been using AI for a number of years now. Do large language models like ChatGPT mean that it's possible to step up that work?
Yeah, it's very interesting, the pace of development around generative AI. As you say, we've been using AI techniques for many years, particularly extractive AI, getting information out of the content sets we've got. And what the large language models are doing with generative AI is giving us the opportunity to improve that interface between the user and our content effectively. It's not so relevant for our risk business, which a lot of it is machine to machine. But certainly it's very relevant to our legal business, where we're already launching products in using generative AI, and also for the STM business as well.
Obviously, risk remains your biggest single business segment. Is there much change in the composition of demand growth that you're seeing there?
No, I mean, very consistent growth actually over the last few years, and we put 8% growth out this morning for the risk business. It does have different within it. There's our insurance segment. There's what we call business services, which does a lot around fraud and identity. And you see some ebb and flow with the economy and with the insurance cycle, but actually the core driver of the growth is the new analytics we could bring to market and the new data sets we can bring, the new content, and that's how we're driving that consistent overall growth.
Obviously, in academia, there's an ongoing debate about open access to articles. I think you publish more than 500,000 per year. What proportion of those roughly are free to consume?
Yeah, we as you say, we publish over 600,000 articles a year, and about a quarter of those are published on an author pays basis, so free to read. And we're quite happy to work with the different payment models. There's customer choice is very important, and different customers want different things, and so we have an offer in a pay to read or a pay to publish.
Well, see, it feels certainly here in London as if there's a bit of a slowdown in the legal market. Things not quite as buoyant as they perhaps were 12 to 18 months ago. That doesn't appear to have impacted you at all.
Well, the key driver of our legal business actually is the increased use of legal analytics. So that the legal profession is really evolving and adapting to using the content and the analytics, the decision tools that we're able to provide. And that's a much bigger driver than actually what's going on in the legal market more generally. And it's a relatively small spend within the overall budgets of a law firm, but of course can create great value in terms of efficiency if they use our tools.
There's obviously a big debate going on here right now about whether companies can get a better stock market rating in New York than London. Your business is more than 60% now North America. Would it make sense for you to move your main stock listing to New York?
Well, I think we feel that the main driver of value creation for our shareholders actually is consistent financial performance and growing the business, and that's what we're primarily focused on. We do review the listing every now and then, periodically. We did it a few years ago, actually. If you remember, we went from a joint Anglo-Dutch structure and just consolidated into the single UK structure. So we do look at it periodically, but we don't have any plans to change anything at the moment.
It's obviously a very tight labour market right now, Nick. Where are you struggling, if at all, to attract the right people?
Well, we obviously need people with all the right skill sets, particularly around technology skills, and so we need software engineers, we need AI experts, we need all those skills, and in the industry domains that we serve as well. So we need legal experts, we need identity and banking experts, insurance experts. So it's always a challenge to attract and retain the right talent. But we have a very good employer proposition and a very good mission at the company, which enables us to attract people. And we're always working on how do we keep innovating and keep making ourselves more efficient so that we can make people as productive as possible inside the company.
That was Nick Luff from Relx. I can tell you the share price is currently ahead by some 3%. I'm pleased to say we can now rejoin Rachel Winter at Killick & Co. Rachel, good to see you. What did you make of Relx's numbers? I mean, the market seems to quite like them.
Yeah, they do great results. I think there's a lot of interest in Relx at the moment because of artificial intelligence, as you said in that interview. I know that Relx has been using this for a long time, but I think investors now are really looking for companies that could benefit from using AI. And that includes companies that own a lot of their own data and information. And that definitely includes Relx.
Obviously a busy day for results today. Barclays is the one that seems to be attracting most attention. The stock price is off quite a lot.
Yes, I think part of that might be due to the issues with NatWest and Alison Rose yesterday. So I think that has caused some wider weakness in the UK banking sector this morning. With Barclays, I think the results were a little bit disappointing, and that was mainly on the investment banking side. So over the last couple of years, I think there has been a lack of appetite for these big deals because the market has been quite volatile, and that has really hit profits on the investment banking side of Barclays.
Yeah, you mentioned NatWest. I mean, it was interesting doing a I mean, I know they're not exactly identical businesses, but NatWest have a far higher return on equity in the last quarter compared with Barclays. What do we expect from them tomorrow?
I think they will have improved, and I think they will have benefited from the higher interest rates that we have seen here in the UK, which will have allowed them to charge more on loans. Barclays too has benefited from that, but not enough to compensate for the decline in the investment banking division.
Now, further down the corporate food chain, we heard today from Foxtons, obviously a bit of a barometer for the London housing market in particular. What did you make of what they had to say?
Well, it's obviously a much smaller company compared to some of the very large ones that have reported today, but it does give a good insight into what's happening here in the UK. I thought it was interesting to see that, unsurprisingly, the volume in their sales division has declined a lot, but they have done very well in the lettings division. That's because there's so much demand for rental property in England at the moment. And in particular, the prices of rents have gone up so much that has really benefited Foxtons. So the increase in profit they've seen in the lettings division has more than compensated for the decline in the sales division.
Rachel, it's a ridiculously busy day today. 16 footsies I make it at the last count reporting. It's good for you to spare us the time today. Thank you.
You're welcome.
That's it from me. I will be back at 4:30 this afternoon with our afternoon edition. Bear in mind, as I said earlier, I'll be speaking to the CEO of Jupiter Asset Management there, among my other guests. Hope you can join me for that. In the meantime, do stay tuned. Coming up after this short break is Jane Secker. Hopefully see you later. Cheerio.